Today, folks, as the passive income investor, I'm here to tell you that everything I've been doing, a complete scam. It doesn't represent the full story. Every investor out there right now is trying to talk about how passive income is a scam. It's like a clickbait title. Dividends, option ETFs, forget those. You're getting ripped off. Just put your money in an index fund. Sure, that's an option, but I want to talk about why this is a little bit misleading from so many variable points. And we're going to start with Meet Kevin, and then we're going to compare some option ETFs and why I think those perhaps are a passive income scam. But I got this article in my email, and I follow so many YouTubers, PPCE, and if they write articles, I'll sign up to them. I love reading what they're talking about, but this one just hit me a little different. The idea of multiple income streams being the holy grail is a fallacy. By Meet Kevin. Most of the time, you're being misled. Someone who makes money driving Uber, has money in REITs, dividend stocks, and some stable coins technically has 4 streams of income. Passive income almost feels like free money, but that's not a good thing for your spending. No, making extra money. That's not good for your spending. Worse, that money gets taxed. So $100 of passive income is more like $70, $60, or maybe even $50 depending on your tax bracket, because Meet Kevin is an idiot. He just wants you to blindly presume you're losing all of it to taxes. If you live in Canada, hey, you're only paying 15% on Canadian dividend stock income. 15%. That means you're keeping $85 out of the every 100. Your capital gain tax in Canada, you're only paying your nominal tax bracket on 50% of the gains. That means half the income is completely free. And let's not even talk about if you live in the US, you got a 401k, a Roth IRA. Here in Canada, TFSA and RRSP. The likelihood of you paying any tax on any of that is nil. It's like none, at least until you get to retirement, so you can compound that tax-free in perpetuity for the rest of your life. Well, what are you talking about, Kevin? You don't know what you're talking about. This is written by an AI. I know it. I know he's writing articles from an AI because this is the most generic BS I've ever heard. On the other hand, asset appreciation leaves you feeling like you have less cash to blow and isn't taxed like income every year, allowing the value of those assets to continue to compound. That's right. But then eventually you got to sell those assets. You got to take capital gains. It becomes passive income. And there you go. You're taxed again, losing all of it. You're going to end up with $50, damn it. So don't be so quick to compare your passive income to others, other people. It doesn't tell the whole story, says Meet Kevin, the guy who claims to be a financial advisor, runs financial assets. He tells you nothing he writes is financial advice. It makes perfect sense, doesn't it? This is a guy that's taking your money right now, if you're giving it to him in his real estate fund, who hasn't bought a single piece of real estate from my understanding and is presuming the whole market's going to come tanking. Like I said, I make a lot of fun of Meet Kevin, but when I see stuff like this, I just can't wrap my head around it, because multiple streams of income being the holy grail is a fallacy. Owning rental property, rental real estate that cash flows, you've done the numbers on, makes perfect sense. Building a bond and a stock portfolio, even if it's S&P 500s, just some bank bonds, all that fun stuff, that's just a complete fallacy to income. Okay, sure. Anyways, moving aside from that, let's just talk about what I think is kind of a passive income scam and why you need to be a little careful. And then we'll talk about actual assets and show you what long-term compounding passive income can do for your portfolio, especially if you're not an idiot like me, Kevin, and you know how to tax it efficiently. But taking a look here, this is the S&P 500. This is the benchmark. This is the best, thing you're ever going to compare yourself to, and you should always be comparing yourself to it if you're buying individual stocks, buying a multitude of ETFs or bonds, because this is what this is what's going to be your comparable to performance. And if you underperform this consistently, you got to slap yourself, wake up to reality and be like, hey, I'm doing something wrong. I'm detrimenting my long-term retirement, and maybe I should just be putting more of my money here. So a lot of people are telling me that, I've seen Passive Income Investing, another YouTube channel that really promotes these, and I think it's not a good idea. I've seen people constantly pushing these, like Hamilton Canadian Financial Yield Maximizers and these TSLYs, these Tesla Option Income Strategy ETFs. There's things like QYLD in the States, JEPI, RYLD. Let's just compare a few of these. Now, HMAX is writing, I think, at the money calls. It's way safer than out of the money. The problem is you're technically paying a lot of higher fees, not just to write the calls, but the management takes a massive fee. And over long periods of time, these things have always underperformed the market. Yeah, you're going to be getting yields of 15%, but just do a quick comparable since January of 27 or 2023, but January 27th, this thing is down about 10.65%. Forget the yield. Forget looking at the income. Let's just take a look at this one. So from January, if we take a look at the 27th, right at the same time, this thing is up about 10%. So you can do some comparables, run the math. I think this thing is yielding 15%, but we're only halfway through the year. So, let's say you made 7% off the dividend thus far. So you're down 3%. whereas the S&P 500 is like crushing it in comparison, right? I mean, you can just take a look. Now, these are all newer and they haven't had a long time to compound and give you a full idea of the management and the option strategies. Like this yield maximizer that claims it pays 50% on Tesla just can't be true. And I talked about this in the past because, again, you look at the volatility in the dividend income. At the beginning, you were getting around 90 cents. What is this? The yield on these were crazy. Now they're just dropping off and they're becoming super volatile depending on what Tesla stock is doing. Again, I know people love these. I got nothing against them if you want that kind of income in your portfolio and you like having the cash. Typically, options aren't taxed nearly the same. Usually, actually, they're more tax efficient than even capital gains or dividends to some extent. But at the same time, I think if you want a small percentage of these, you really want that cash flow, you're at a retirement stage in your life, that's where this would make a little bit more sense. But if you got another 20 or 30 years out, look at QYLD. Any of these that have had long histories, long standings in the market, they have just wickedly not returned anything substantial. The dividend income hasn't given you any growth. I mean, there's been no long-term compounding of dividend growth. So you're just literally paying management to underperform the market. And yeah, you get a little bit of cash flow. But is it truly worth it? I mean, again, take a look at JEPI here. This is the JP Morgan a premium income ETF, right? And I think the yields, these all yield like 8-10+% or whatever. This thing's up 10% since what? I mean, May 22nd of 2020. Take a look at what, the S&P 500's done since May 2nd of 2020. Let's see, April, May, right around May 1st there. This thing's up 56%. That is what you've given up for cash flow if you're not actually utilizing the cash flow and you're just buying it because you think you're getting some kind of income benefit, right? So let's just do a quick comparable to something like SCHD, for example. You can even do a quick comparable to the VOO and the dividend growth that VOO is even offered from the S&P 500. But for me personally, I like the idea of what Dave Ramsey says. He'll always mention things like growth ETFs, growth in income, broader market. He gives you like this perspective of building a portfolio that kind of takes advantage of everything, and that's what I like. I like owning the broader markets, the S&P 500. I like owning SCHD because it gives you growth and income. This is probably the true premium idea of passive income. And though past performance doesn't equal future return, we're in a more volatile market. It's likely things are going to slow down here. But this past performance has been something that if you captured this, I just have to say congratulations, because SCHD came out in 2011. The thing's up 185%. You take a look at the dividend income growth from 12 to 14 cents a quarter back when it IPO'd, or they started trading. Today they're paying out 60 cents, a 4 or 5x on the dividend. I mean, your yield on cost would have been incredible. Your capital gain growth would have been incredible. You put this in a tax advantaged account, it would have compounded tax free for the most part. And this is the true holy grail of passive income, something that isn't just generically written in an article. You're looking at individual stocks. You're somebody like these dividend investors out there. Let's just do a comparable with the largest company in Canada that has been for a very long time, Royal Bank. I mean, this thing's got a lot of history of growth behind it. And if we take a look at the dividends here, I mean, you go back to 2000, 20 years ago, you were getting about 13, 14 cents a quarter. Today, you're getting $1.35. And these things you can hold generationally. These things you can sit on, collect the dividends, and know you're always getting an increase in wage that's helping you fight inflation. That's not something you're getting from a lot of these option ETFs over long periods of time. You look at something at the largest company in the U.S. You bought this 10 years ago, and again, it isn't something an idiot needs to figure out to buy. And again, this is a company that's doubling its dividends. Yeah, you're not getting the biggest dividends, but you're still getting the dividends and the appreciation, which in my humble opinion is the truest form of passive income. And I would much rather underperform on the yield side of my portfolio today, knowing when I get to 50 and 60, that cash flow I'm raking in will just allow me to not have to sell off much of my portfolio. I'm in a great place. I'm not worried about capital gains as much. And even if I need capital gains, I can sell them out of the tax advantaged accounts and still not pay any tax. And oh my God, guys, don't think passive income is a scam. Don't listen to these stupid articles and these people on YouTube that just beat it up. There's a lot of ways to build a nice passive income portfolio and perform with the S&P 500, and even just use it as part of your passive income portfolio. It's all the same stuff. But I'll just pass that question off to you. I'd love to know what you think.